everybody for continuing to commit your time to these topics today, and thanks to Mac especially, and Mac and Tom for really talking about some big ideas there. And you know, my feeling and the squirming I saw around the seats, I think it was good. I think everybody was equally as uncomfortable about certain ideas, but I mean, we're thinking big on some things, and we're getting real specific on others. So it's really good to open up this dialogue and hear what everybody's saying. And I heard a great, I feel like the Mac's talk really spurred a lot of really good conversation coming out of it about, okay, what pieces actually do apply locally. So great to have that happening. So we'd like to kind of bring it back to specifics of development and kind of local. And we've got another, we feel like, strong panel here that is going to hit kind of the economics of developing projects here in Raleigh. You know, lots of different types of housing, and great set of panelists. So I'd like to introduce Joe Whitehouse is going to lead the panel, and he's the president of Creative Urban Environments, which is a real estate development service known for its creative and human sensibility. Joe brings 30-plus years of experience as a development partner and consultant to a variety of products, including commercial, hospitality, mixed-use, multifamily, retail, and resort development. His most recent projects are the Cypress of Raleigh, the Aloft Durham, and the Aloft Raleigh, and is currently working on a few projects now in pre-development. He's married, 2 children, located in Raleigh, and works throughout the Triangle area. And anybody who's experienced any of his projects can certainly see, you know, his caring for the community we live in, and improving, you know, different areas, whether it's Durham, Hillsborough Street, you know, North Raleigh, the different areas you're working in. So, Joe?
It's my pleasure to introduce our panelists to everybody today. And on the far left, Alex Cathcart. Alex is a VP for FCP, where he sources and executes their multifamily acquisitions and developments in the Southeast. He's located here in the firm's Raleigh office. Prior to joining FCP in 2012, Alex worked in the real estate group of Wells Fargo Bank. Alex is an active member of ULI and graduated from the University of North Carolina Keenan Flagler Business School. He moved to Raleigh 3 years ago from the Washington, D.C. area. In the middle is Erica Latham, and she is the VP of Planning Entitlements for MI Homes Raleigh Division. Erica previously worked with Lennar's Raleigh Division, where she was the Director of Land Acquisition and Entitlements. She moved to Raleigh 4.5 years ago, also from the D.C. area. We got a theme going on there. It's actually where I grew up, too. She was a partner in the real estate department of Ballard Spahr, specializing in zoning and land use matters in the D.C. metropolitan area. While there, she was named among 2012's top 100 women in Maryland by the Daily Record in Baltimore, in recognition of high-achieving Maryland women who are making an impact through their leadership, community service, and mentoring. In addition, she received the Commercial Real Estate Women Crew Network's 20 Under 40 Award, recognizing leaders in commercial real estate, and the Washington Business Journal's 2010 40 Under 40 Award, honoring professionals based in the business community and involvement. In 2011, she served as a co-chair of JWI's Women to Watch Gala. Eric has also been very active in ULI locally, and has been working hard to help educate others in the marketplace with ULI's urban plan for public officials. And lastly,
that's a lot.
That is a lot. You got quite a record going.
I guess so.
Next panel.
And to my left is Tim Morgan, is the Vice President for Evergreen Construction Company, a full-service development, construction, and management company working in the affordable housing industry. Tim manages all 3 divisions, development, construction, and management of the company, and has been with Evergreen since 1994. Prior to that, he worked with 2 other firms in the affordable housing industry. Tim is a native of Eastern North Carolina and came to Raleigh in 1986. He attended East Carolina University, receiving his degree in concentration in management. He also holds a North Carolina real estate license broker.
Right, and I have visited Washington, D.C.
I thought you were going to say Little Washington.
I've been there
the real
too.
Washington. Well, what I wanted to do is I'd like for each of you to spend a few minutes and just talk briefly about your company and the kind of things that you're doing initially. And Tim, why don't we start with you?
Sure, thank you, Joe. Evergreen is a full-service company. We're locally here in Raleigh, and we only operate in the state of North Carolina. We've been around since 1978. We specialize in the affordable housing arena. We've got 43 rental communities in our portfolio, which is just under 1,900 units. We're a slow but steady growth company, and we're currently working on 3 projects, senior projects, one in Raleigh, one in Cary, and one in Goldsboro.
Great. Erica?
Hi, good afternoon. MI is a national home builder. We have been in business for about 40 years, headquartered in Columbus, Ohio. Built over 100,000 homes since we started in Raleigh. We've been in this market for about 20 years. We're one of the top 5 builders in the country and the top 5 builders in this particular market too. We are not an entry-level builder. We focus on in the $300,000 range to about the $500,000 or $600,000 range. So even though we're not necessarily entry level, we do have a lot of first-time buyers, and we can talk about why that is later. And we are on track to build about 400, 450 homes this year in this market.
Great. I'm Alex again. Based up in the DC area in Chevy Chase, FCP manages a series of closed-end and separate account vehicles, and we invest primarily up and down the East Coast, although we're kind of moving nationally, in value-add, core plus, and development, multifamily and office investments. So we're currently investing a closed-end fund that's about $750 million across our markets, and then we're investing a separate account with a large pension fund into more core and core plus assets as well.
Great. To kind of help the stage, set the stage for everybody too, let's talk a little bit about kind of deal structure and how you put your projects together and kind of what are your hurdle rates and how do you sort of set up a project initially and just the key characteristics of what your projects might deal with.
Okay. Well, we typically do 9% tax credit deals. So that's an application process that starts with the Housing Finance Agency in January, and by August you know whether you have something or you don't. But if we are fortunate enough to get the credit allocation, then we syndicate those off to investors, and that typically brings in about 65% of the equity needed for the entire deal. And then the other 35% comes from conventional debt. One of our partners is North State Bank. They're out here in the audience. And then I see 2 tables over there with the City of Raleigh staff, and they're another partner that we work with quite a bit because we've got 19 properties in Wake County. So we access City of Raleigh funds quite often, as well as Wake County dollars. And we are fortunate enough that our local politicians have stepped up. The City of Raleigh, passed a penny for housing a year or so ago. That brings in about $6 million a year. And then our county commissioners last April really stepped up to the plate, which will bring in another $15 million. And these are reoccurring dedicated sources, which is very, very important. So now we've got about $21 million that can really go and make a dent, we hope anyway, in the affordable housing crisis. So.
Well, from a private development source, thinking about what your capital stack requires, it gives us all kind of a pause. There's a lot of work to put together for sure. Erica?
Yeah, we're pretty vanilla when it comes to deal structure. It's a public company. We don't have to go out and raise any money or attract any or get any debt. We'd love to find finished developed lots and build homes on them, but it's very difficult to find a finished developed lot. There's just no profit in it for a developer anymore. So we'll often buy land raw from sometimes a farmer, sometimes a developer. And we'll entitle it, we'll develop it, we'll build the homes on it, and that is our soup to nuts process. And I could not leave this topic without asking anyone in the audience if you have any land for sale products. Please see me later. I should have mentioned at the beginning, we do townhomes and detached products. Love to be in mixed-use areas.
The ability of the shameless plug.
So we're a money manager. We raise almost all of our money from larger institutions such as endowments and pension funds who are tasked with managing their money and placing it responsibly and building capital over long periods of time. And so we would fall into sort of the alternative asset management category. And it's kind of important to have the perspective that those folks, really anybody who invests in real estate, they have opportunity costs. So for those that invest in us, their opportunity cost is the public markets, it's other product types, it's other industries. So that sort of creates benchmarks and targets for our industry, and that drives our capital. And so we're typically driven by producing a levered internal rate of return on our investments, and those typically need to be in the low to mid double digits or teens, and we invest capital basically as equity, direct equity in acquisitions and repositionings, as well as ground up or adaptive reuse projects. And we finance it fairly conservatively with 60 to 70% leverage from large banks, life insurance companies, the agencies, and what have you.
Great. Erica, I'm going to direct this question to you, and because it's so much on everybody's mind about how competitive it can be to buy a house in recent years, and kind of what are the dynamics that you guys are seeing and with your new developments, and where's the demand today, and how are the builders able to meet it?
Yeah, so it depends on the segment of the market that you're in. The demand for an under $250,000 house we're simply unable to meet it because we can't produce a house for under $250,000 in the primary and secondary markets. You have to get to the tertiary markets before you can do that. We have seen, and not just at MI, but I think throughout the home building industry here, it's still a very strong market under $400,000. A little softer between $400,000 and $600,000, but now that interest rates have gone up, that upper end $600,000, $700,000, $800,000 market is pretty soft. You're seeing those people who wanted to move up to a $700,000 house perhaps stick at the $500,000 level because at a 5% interest rate versus a 4.5% interest rate, that makes a big difference in terms of the monthly payment. We're also seeing pretty strong demand from first-time buyers and not at the entry level. These are buyers, perhaps they came out into the job market in 2008, 2010, have been living with their parents for a couple of years, now are renting a home or renting an apartment, and with apartment rent increases, they're now thinking it's time to go get a home, to buy a new home. So we're seeing a lot of first-time buyers who have enough money to put down 10% for a down payment, and they want a house with a yard, perhaps not all the way out in the suburb, in the exurbs maybe, but certainly in the suburbs. And then there's people moving from out of state, a lot of people moving from out of state. So even though the interest rates are going up and perhaps we might be in need of a price correction soon, if you're moving from California or if you're moving from DC, the house prices here are terrific, and there's a lot of demand at that $400,000 to $500,000 level from migration from different parts of the country.
Erica mentioned the demand for the 200,000 type product, and it's kind of not out there. Well, fortunately, the city of Raleigh is doing a redevelopment project in downtown Raleigh. It's referred to as East College Park, and with their help, we are able to hit that $200,000 market. With the help of the city, selling us the lots at $25,000 a lot. So the homes, the 3-bedroom, 2-bath, ranging from like $1,250 to up to 1,700 square feet. We're selling those in the low twos, and obviously they're going very, very quickly. As soon as we get an allotment from the city, within a week they're under contract, and so, as Erica said, there's not that much product out there, but being so close to downtown, I mean, that's where millennials want to be, and that's primarily who our buyers are, is that millennial age. And this program is a mixed income, if you will. 60% of the homes have got to be sold to households at 80% of median and below. and the other 40% can be, any income bracket. They're referred to as the market rate. There are, caps on the price of the homes for the affordable side, which is currently $242. On the market side, it's $260. That will soon become the cap on the affordable side if we don't hurry up and get these things built out. But there's a 10-year deed restriction for all buyers. So if they sell within 10 years, they're going to share a portion of that profit back to the city, which is the right thing to do.
Just, can I follow up on that for just a second? I mean, just to give an order of magnitude for the audience, when you say you're getting a lot for $25,000 inside the belt line, if that were market, that's probably 60,
Keep going.
70.
Keep going.
I don't
Keep
even know.
going.
I see these deals and I can't make them work. So, I mean, you're almost getting the land for free.
Yeah, I mean, it's a heck of a deal for the home buyer because they are walking into instant equity.
Well, I think the land pricing is something that everybody is struggling with too, when you look at suburban versus urban. And, we're seeing people go in and buying homes at, $300,000 and $400,000 and tearing them down and building a new home today. So it's a hard thing to compete. Tim, are most of the buyers at East College Park, are they first-time home buyers?
I would say, at least with us, they are first-time home buyers. Like I said, they're the millennial age, 1 to 2 person household, so they really haven't started the family yet. On the affordable side, their income bracket is about 36 to 42, and then what we're seeing on the market side is anywhere from 75 to 98,000.
Erica, where are you seeing most of your development take place today?
You're seeing a lot of clustering kind of around the 55 corridor from RTP down south to Fuquay Varina and Holly Springs. There's a lot of interest in, I call it downtown Durham adjacent. And you're also seeing some push into Johnston County where you can get some more affordability. Same thing with call it Northeast Raleigh.
Where do, you're all kind of hitting a bunch of different, a number of different home buyers today, or renters for that matter as well. Where are you seeing the highest demand today? Where do people want to be?
They want to be near amenities. I think the speakers this morning all touched on it in one way or another. They want to be not necessarily near a destination, but they want to be able to walk to get their groceries if that's possible. If they have children, they want to be able to walk to school. It's going back to that old village concept where you have some limited commercial retail, but destination, something to do and somewhere to go as part of your community.
Yeah, we're seeing schools drive a lot of the interest, not only from renters, but also capital. So that drives a lot of it, particularly in the suburban locations. For more urban locations, schools are less relevant. There aren't as many kids in those communities. That's more about your live, work, play.
So kind of, Alex, on the other end of the spectrum with the rental spectrum, we've seen a big explosion here in the marketplace over the last several years. I can think it was talked about earlier this morning too, is just how much longer can we expect to see the rental market boom go on like they are with the multifamily development?
Yeah, there are a lot of things at play with that. It's been quite favorable for developers throughout this cycle, hence all the cranes and all the construction. However, that is slowing down quite precipitously because of a number of factors. On the rent end of the spectrum, you had this sort of design race throughout much of this cycle where one project would be built and then the next one would be built to a higher and better scope with greater finishes and amenities and whatnot, and it would jump over the prior deal in rent. And so while same store rent growth has been decent amongst Class A, it's really been sort of that new store rent growth leapfrogging. And so that's been a big trend, rents moving from the upper $1 square foot range in Class A maybe 6 or 7 years ago. So that means call it $1,800 on average. Now we're up into the 2000s. The nicest projects have rents in the $2.30, maybe $2.40 range, if they're lucky. So there's been quite a an increase. However, another input there has obviously been cost, and folks touched on it earlier. Virtually every component of cost has gone up, from labor to time has become longer, to hard costs, to land, and those prices, that appreciation has actually outpaced Class A rent growth, and it's gotten to a point at which it's incredibly difficult to deliver new product and meet the returns that the market requires. And so then there's the question, well, why don't you just kind of dumb down the product? But that doesn't really pencil. And dumbing down the product and going for lower designs and whatnot, and a slightly lower price point hasn't worked. If it worked, other people would be doing it, right? And not to mention a lot of the municipalities and whatnot that help, oversee all of this want, nice, good, long-term product to be delivered. So it's sort of a give and take there. So I think, we'll see a pretty sharp decline. There's enough capital out there that projects still will get built, but we'll see a pretty sharp decline in deliveries in all of these kind of southeastern markets here over the next year or two. And what that could mean is some rent growth. And because of tariffs, because of a tight employment market, people aren't necessarily expecting costs to come back down, and land sellers aren't likely to let costs come back down either. So that means we'll probably see some rent growth because, well, we touched on the cost burden a little earlier. It's generally still in check here. So there's room for some rent growth with the incomes locally, both at sort of the mid-level and the higher end of the spectrum. And that also means probably some rent growth, at the lower end of the spectrum where they'll have some headroom, and things are generally, relative to some other markets, in check on the cost burden side. The other thing I'll mention is, you might ask, well, if the cost burden's in check, in other words, income to rent ratios are pretty well balanced, high level, at least in my opinion, why aren't we seeing more rent growth? And then it kind of comes full circle back to the home building, back to Raleigh versus other cities. People have alternative housing options at a certain point, so that kind of places a cap on where rents can go. So,
At the opposite end of the spectrum, again, we're the affordable housing development group. Demand far outstrips the supply. We've got a portfolio-wide, we've got a 4% vacancy factor, which is pretty good. We are working on a project here in Raleigh. We haven't put out one sign. We haven't done any marketing, and we've already got over 200 inquiries wanting applications once we start that pre-leasing part, and there's only 42 units. So needless to say, they're going to go quick. We do our senior housing, our typical tenant profile is 67 years of age, single, female, about $22,000 in income, which is Social Security and some small pension. So it's amazing there's a lot of folks out there like that. And our family, typically it's a two-person household, working about 22 to 24 in income. And again, like we all struggle with, finding the land is hard enough. It's a very competitive process in the LIHTC world. For example, 150 applications were submitted at the pre-app stage. Then at the full app stage, if you want to continue down that path, this cycle 116 were submitted, but yet 38 were funded. So you have out the gate, you have a 25 to 33% chance of getting your project funded.
And that's a lot of work to put together, to put these applications together.
It's a lot of work. Yes,
And
it is.
what's your cost to put together an application typically?
It will vary just depending on, if you've got to go through the rezoning process, but it can be as low as, 10,000, or it can be as high as 50.
Right, right.
So.
Alex, I wanted to follow up a little bit on the multifamily area, because we've seen kind of a new submarket growth of the Class B and Class C apartments, which is a lot of the NOAA housing that is sort of being displaced in the marketplace, and we're seeing a lot of pressure on taking units out of the naturally occurring housing, and where do you see that going?
Well, it's interesting. It's sort of been highly publicized, highly discussed, and cap rates in that space are as low as cap rates for brand new core product now, and that's because of the opportunity and the potential for growth. The broader market really likes the supply and demand imbalance in that space, and has seen tremendous rent growth, and we're sort of in a macro economic environment where people are projecting more wage growth and more ability to push rents, where inflation has finally picked up a little bit, unemployment is pretty tight. We've seen some wage growth for the past 24 months or so. And so there are quite a lot of indications that the sort of working class that lives in those communities are going to be employed, be in high demand on construction projects and things like that, and going to see some wage growth. And so I see that space continuing to be, from an investor standpoint, pretty hot, and that means people will continue to pour capital into these projects to try to squeeze yield out of them, and try to push rents to meet their target returns. So, I kind of see that trend continuing.
Any feel for when people are buying these Class B and C apartments, putting some capital money back in, raising the rents, how much of a turnover are they seeing?
I'm not sure. I mean, I think a stable Class B or C property generally turns over, on the low end, 25% of the base, the tenant base every year. On the upper end, 45, 50. Folks have different approaches. There's some people who are really aggressive and they renovate every unit immediately and try to push rate. So that pushes people out, and you inevitably, over the course of a year or two, turn over a lot of the rent roll.
So if you take a 300-unit apartment project and it has a 50% turnover, that's 150 new homes that those people need to find somewhere, isn't it? That puts a lot of pressure, Tim,
Yeah,
back in your
there's a lot of
community as
friction.
well.
It does.
Trying to find some new housing. Well, we've heard a lot today about rising construction costs and obviously rising land costs, and what kind of things are y'all doing to sort of combat that and deal with that? And because you're still obviously developing and buying and building, so you're working through it somehow. You haven't put anything on the shelf yet, I take it.
Well, I actually had a seller tell me that he was still partying, this is a quote, partying like it was 2006, and he wasn't going to lower his asking price, so either I could meet it or I could go. So,
You let that one go.
no,
No, she owns it.
I took it. But to your point, I mean, that puts more pressure to
Yeah.
figure out a way to, I mean, construction costs or hard costs have gone up. Actually, I wrote it down exactly. Development costs have gone up 8% over the last 2 years. Construction costs have gone up by 10%. And that's just over 2 years. So my land prices are going up, my development costs are going up, and price appreciation is really only about 7%. So I've got to figure out a way to act more efficiently, whether it's being able to bring projects to market more quickly, going through the entitlements more efficiently, or putting pressure on other parts of our company to negotiate better deals with our suppliers. And I think we're going to start to see some success there, and a couple other speakers have alluded to this too, that we're not quite at the velocity, at least in the home building industry, that we have been in the past, as some of our subcontractors have a little more free time. So we're able to negotiate some better rates with them, but that doesn't really apply to lumber. I mean, those prices have gone up, and I guess they just went down with the Canada trade deal thing. I should know more about that, I apologize. But the steel and aluminum tariffs are going to start impacting the home building industry soon. So I know we just got to be smarter about what we're doing, and I'm not there yet.
Tim, what do you
Well, I mean, we're in the affordable, or you're not immune to it either. We struggle with the same thing, whether the lumber's going to a market rate project or an affordable project.
It's the same price.
It costs the same, basically. And in our program, you submit in January, you know what you got in August, you go through the permitting process, you start building the following year, and you got to get a place in service within 2 years. But once your project's awarded those credits and funding, you're kind of locked, and you've got your rents. And so, we did run into some bumps in the road in 16 and 17, where we had projects stalled. In some cases, we rolled the dice and took it back through the application cycle. We were fortunate enough to get one refunded that way. It was better sized. Another one, we went to multiple places of money and got turned down, but then we approached the county, and they, to their credit, they stepped up and awarded additional dollars to the project to make that one go forward. So, I mean, unfortunately, the costs are high, and we do have gaps. We also will reduce our profit. We will reduce our fees to make it hopefully work, but you can only do that for so long before you're out of business. And, everybody needs to make money so that we can all continue what we're doing.
Yeah, Wall Street doesn't like it when we start having to decrease prices and margins, but someone's got to give somewhere.
Alex, how about you in the multifamily area? How's it affecting y'all?
Yeah, I mean, the amount of new developments will finance, right now or over the coming 12 months will probably be lower than 2013 levels. That will just be a reality, and that may mean we're more keen on purchasing newer product because we like the growth potential there because there isn't new supply. So that's probably just a reality we're facing. However, we're fairly bullish on all of these southeastern markets, particularly Raleigh, and so we're trying to find ways to, quote unquote, be where the puck's going to be, and so we're actually we're quite research oriented, and we do a lot of drilling into submarkets and trends and seeing where there might be good outsized growth potential in a certain location because of X, Y, or Z. And so we spend quite a lot of time drilling into sort of micro market factors that could lead to a really nice operating environment if and when we were to deliver a project in, say, 24 months. So that's one thing we're doing. And then the last thing I'll say is we've sought out defensive positions. There are plenty of headlines that make you think there could be some softness in the economy at some point, or you may just feel uncomfortable about the basis of a project because costs are up closer to values. So we'll try to find sort of, lower density, less expensive projects, or perhaps sit in more of a structured position as preferred equity or mezzanine debt, so that we're at a basis that we like, and we can still help a developer who's very bullish on the project sort of realize it and capitalize it.
So we've known for years that at some point interest rates would start rising again, and we're starting to see those rise again. And although it's sort of a predictable level that we're seeing the Feds, is that affecting any of the work that you're doing as well, or your home buyers coming through Erica?
Well, it's affecting different people in different ways, right? On the one end of the spectrum, there's people coming from California or DC or New York, or say hypothetically Rockville, Maryland, where you sell your 2,000 square foot, 50-year-old house for a ridiculous amount of money. And you come down here and you can buy a newer, bigger house for $500,000. I don't care what the interest rate is. I'm happy. So those people, the new people coming in haven't been affected as much. On the other side of the coin, you have people who are living in a home now. Here in Raleigh, they've been there for maybe 20 years. They refinanced 6 years ago. It doesn't make any sense for them to move to buy a new house, because they're not going to be able to get as much house for the same payment. It makes much more sense for them to stay and remodel.
So are most of your
they're not
buyers
moving.
are most of your buyers coming in from other markets?
We have a lot of people coming from either internationally or from other markets, and then a lot of people who have been renting for some period of time. And no, they're a little sensitive to the interest rate, because in some cases they're very payment driven. So where they might look at a $400,000 house, maybe they're now looking at a $300,000 townhouse, but they're still looking to buy. And you have gradients, in between that whole spectrum.
Sure. Tim, does that affect you all at all?
Well, yeah, I mean, we're not immune, just like construction costs, interest rates on the permanent side. When they go up, what that means is, you try and you can increase the rent somewhat, but I mean, we have maximum housing expenses that we just can't exceed, period, in the deal. We have layered income levels. It's not uncommon to have one that'll have 4 different income levels, 30, 40, 50, and 60% income levels. And you don't want to write the deal out the gate at the maximum housing expense. So you got to have some play in there. So when the rates start ticking up, that just means that you have to kind of seek other softer sources, again, from like more money coming from the county or the city of Raleigh. The Housing Finance Agency has some monies available for debt service, but again, everything is a finite source. So, and particularly when you get into some of these rural parts of the state, where your incomes are lower, some deals just don't pencil out, and you just got to move forward. That's why everybody likes to be in Wake County. Well, we're one of those groups that likes to be in Wake County because it's a very popular place, and we have more sources that we can work with.
There's a lot of talk today, and we've heard it today, about transit-oriented design, TOD kind of design, and locating housing in those areas. Are you all thinking about those areas as we're starting to look at implementing some bus rapid transit and some other rail systems here in the area? Are you considering looking at TOD kind of developments for your portfolio?
Well, on the affordable side, the Housing Finance Agency has what they call a qualified allocation plan, so they write the rules that we all have to follow. It's not extremely transit slanted per se. They want all sites, and when you're in these larger municipalities, meaning larger than 10,000 population, because it's a statewide program, but they want the sites to all be within a mile of amenities. An amenity is a grocery store, a shopping that's strictly defined. That could be like a Dollar General, a Dollar Tree, a Walmart, or a Target. and you need to be within a mile of a pharmacy. And then they have some secondary amenity points. But where they bring the transit in is if you are outside of that mile, then you could pick up some points by having a transit near the site. So that's at the moment how they deal with it. They haven't said, let's allocate X percentages of credits and, put it towards, areas in the light rail system, whether they be in Charlotte or, in Raleigh. They haven't gotten that focused yet.
Alex, any thinking about TOD development?
Yeah, I mean, I think to the extent you're looking at an infill project that has sort of transit potential, we're absolutely excited about that. And I think mixed use is proving to be quite successful here. The same trends that you see elsewhere with walkability and amenities on your ground floor and everything like that are real here. And there are a lot of folks, like the folks buying your homes, there are a lot of folks moving in with great incomes that are willing to, to pay to be in those TOD type locations. On sort of the other end, not quite the other end of the spectrum, but, and I haven't really studied it very much, but companies like Uber are also a complete game changer because they make accessibility to your nightlife and whatnot so easy. You can hop in an Uber and you can go to Durham for $20, which is just incredible. So the mobility is just getting better and better. In many ways, of course, commuting traffic's a concern, but.
So much of what we're talking about today is just affordability of housing altogether, and LIHTC or low, the demand is there forever, as you've talked about before, and Erica, you've talked about if you could develop housing at $250,000, you could probably build as many as you could get out in the marketplace, and to the lesser extent from a rental side, if you were able to drop your rents down to 75 cents a foot or $1 a foot, whatnot, that the market would be there forever. But those are the challenges today in terms of how do we keep everything down? How do we keep our pricing down? And are there other methods or thinking that you're all going through in your own businesses in terms of how to combat those? How do we try to make housing more affordable today?
So maybe I'll drop a grenade for this afternoon. As I was listening to Max speak and when he was talking about how they do the TDRs in the different parts of the world and less money goes to the seller, but that the developer, the builder is spending that money. Like that is absolutely true. So if I could have some certainty going in to a development project, and whether that means knowing I'm going to have subsidized units in my housing development, though I do not take that to mean I'm advocating for inclusionary zoning. But whatever it is, whatever the requirement is, whether I have to rebuild an intersection a mile away, whatever that is, if I know that going in, I can then go to my seller and negotiate my sales price. I can get a very good pro forma in the beginning. What kills these deals and what kills the affordability is I've gone through 12, 18, 24 months. I get to the town council and all of a sudden there's a surprise, whatever it might be. But it's an expensive surprise. And then I want it approved, so I'll agree to it, but that means my homes are
That much more expensive.
Right.
That it's a pass-through cost for your buyer, right?
Yeah, I mean, we haven't found a great solution for that, but we just financed a project in the Charleston area that will be modular construction. So that pulls down the hard costs a bit and the labor quite a bit. And so that's an avenue that people are talking about. People are trying to be a little bit more innovative in the construction world to try to save on some costs. And there's a stat I read recently that I think construction companies spend less than 1% of their capital on R&D. That's a teeny little amount. So, and if you've ever worked on a development, there are incredible amounts of people that are involved and touch it throughout the process. So modular development is sort of an unproven way, but a way to streamline things a bit. So that's one thing that we're participating in. Another is using government programs. We do some adaptive reuse projects. There are historic tax credits and the like out there for that. Opportunity zones could be a potential avenue there. Basically, lower the tax burden for capital, so effectively makes construction or their costs cheaper.
It kind of brings up a good point. You talked about SALT and tax and opportunity zones. Are you seeing any changes in your business from some of the tax reductions we saw this year?
Well, on the affordable side, most definitely. When they lower the corporate rates, the demand, well, before they knew what the corporate rate was going to be, there was obviously talk about lowering the corporate rate. So that scared our investors. They were like, how do we price the deal? We don't know what it's going to be. And so, those deals, what we used to get mid 90 cents, some cases upper 90s, and in some states over $1 for $1 worth of credit. When that tax reform was talked about and then finally the dust settled, now we're seeing the pricing anywhere from 88 to 90.5 cents. So then all of a sudden you've got that gap from what you were used to getting. So then you have that combined with rising interest rates on the perm side. It just complicates it more. But it's if it was easy, everybody would be doing it.
Last question before we kind of open it up for questions in the audience is, and this is kind of a pretty general question. I mean, we're seeing the pricing go up, and this is probably a little bit more in the urban areas, but how do we create a community where our kids can live as adults in the communities that they grew up in? What are the things that we can be doing as a community to help out with that?
Well, I would, again, point to what the city is doing. When the private market sector can't do it, that's really when government attempts to step in and help solve the problem. And so, the city again has undertaken that redevelopment in East College Park, which is a total of 98 lots. Again, they're selling them at a sharply discounted rate. They got money from the feds to put in new utilities and things like that. So they're committed to that. I mean, that's the only way you're going to get a product in the low twos. And so the city again has stepped up and said, just like you said, we want to have housing for a wide spectrum of income buyers. And so that's one way of doing it, Joe.
Mm-hmm.
I think you've heard from a couple other speakers too, just expanding the housing options. And I think this will come up on the next panel as well. Durham's looking into expanding the different types of homes that you can build in different areas, the duplexes, the triplexes, and the
So
quads.
the missing middle.
Yeah, the missing middle. But and it's kind of just a market issue. You have more supply, then you can manage demand better. I don't think there's any magic to it necessarily.
Well, great. I think we'd like to open it up to any questions that the audience might have. Of course, it's kind of hard to see out here. We've got one question over here. Oh, it's Councilman Stevenson.
We want to have a more predictable process so we don't get to the council table and then get surprised, right? But we also don't want inclusionary zoning. So it sounds like, okay, how do we close the gap? Because it sounds like a catch-22 between like pre-zoning a project, but for local governments who might be providing land or gap funding, knowing that we're going to get those affordable units at the end.
That's a great question. I mean, if the city is involved in providing funding, then I think that's different. You know, that's a truly public-private partnership where you can have those discussions about what type of affordable units are going to be provided, where, when, and how, right? But if it's a purely private enterprise, and if there, you know, and I don't even know that I'm necessarily against inclusionary zoning as a concept, as long as it's fairly applied and you know what it is going in, right? You know, in my former life, I worked in Montgomery County, Maryland, and they had the moderately priced dwelling unit program. 12.5% of every development had to be moderately priced. You just knew it going in, you underwrote it. It was what it was. So I'm not opposed to that, but it's the stuff that gets not made up, but comes up through the process and then changes, and there's no basis for it, and then one development has one requirement, another development has another, and that's where it gets difficult to manage on our end.
Any other questions?
Can you hear me?
Sort of.
Sort of? Okay, better?
Better.
Okay. So you had mentioned modular as an option. Now, I was wondering, have any of you actually have experience with it and just decided the numbers didn't work out, so you didn't go with it, or it just didn't fit the types of deals you were working on? And have there been any other development alternatives that you've looked into and either earmarked as potential ways of going forward, it just not the timing wasn't right, or is everyone still just sticking to the traditional method?
I've actually done 2 modular homes where it was a multifamily project, and the things that really dictate the use of theirs, obviously there's quite a bit of savings in development time, construction time, when you can come out and build a foundation and stack these units up, put a roof on it and side it and make the connections internally. The biggest issues are finding a shorter kind of transportation cost from wherever that factory is to wherever your product is. And there are not many factories out there doing modular home in a for sale product today. I think the most current project we've had here recently was actually a hotel in Chapel Hill, and I don't know if anybody's seen the new AC hotel there. It was kind of a traditional build to start with, and they stacked them on top, but at the end of the day, it ended up costing them more than a traditional build. So it hasn't quite reached it when they had to ship these particular units from Pennsylvania down to Chapel Hill. The transportation costs were high, but if you've got a manufacturer that's close by, because I know 2 projects that I've been associated with that we did in the mountains where you've got a very short construction season or a very difficult winter season, that they really went up in 6 months. So I mean, they cut the construction time basically in half, which was great, but the plant was close by and we could ship in and make it worthwhile.
We have not used a modular type construction method. Closest we've come is, having our lumber supplier build the panels in their factory over in Apex, and then bring them out to the site and just, put them up that way.
Yeah, we've been experimenting with the same thing.
Yeah, there's 2 projects off of Hillsborough Street right now that they're using panelized construction, and they seem to be going along pretty well. That's kind of a new technology. Any other questions? Right here, TJ?
Sure. I had a question for Tim particularly, and maybe kind of compared to Alex. Is Tim, do you deal with the same construction cost as any other, any other market-based development? Do you track your costs in terms of, you might get a deal on the land, or you might get a grant or gap funding from the city and that type of stuff? Do you track your costs as with set rents where you kind of need to be after all your subsidies, maybe per unit or something like, or do you think of it that way? Do you have a number?
Well, the Housing Finance Agency has a number that in their QAP that is 78,000 a unit, and that number is just a sticks and brick number.
So hard cost.
So no profit, no overhead, no site, no contingency. That number is. Now, if you submit your application over that number, you're going to take a negative 10-point hit, and then you won't get funded. So guess where your construction number goes on the front end? I mean, so they're doing your budgeting for you. But the reality is, what we're seeing is 80 to 81,000 a unit right now. Again, just on the sticks and the brick, which is about a $67 square foot price. So that is hard cost. That's correct. No, but I mean, on a LIHTC deal, if you put in every line item, which are hard costs, soft costs, reserves, monitoring fees, you name it, you're about 160, 165,000 all in. If you're looking at just your construction cost with, builder profit and overhead, and I'm throwing in some number for site work, you're at about 120 a unit. And we have design, the agency has design criteria that we have to follow as well. So, you can't veer off of that, again, or you won't get funded.
Great. Do we have any other questions? I think we've probably got time for another question if there is one. Well, if not, TJ, we'll turn it back over to you.
Well, thank you very much, panel. Maybe we get a round of applause. Very much appreciate everybody's, openness with the whole group, and talking through numbers and thoughts on public, interactions and that type of stuff. Just as a summary, it does seem like there's not a sense really that costs are coming down, and therefore there's not a sense that rents will come down. In fact, it feels like in a supply somewhat, sorry, just trying to help everybody. Maybe in a market that feels like, three people, boots on the ground, trying to do deals, and very much incentivized to do as many deals as they can. They're feeling a lot of headwinds to getting that done. It feels like maybe even at the top end, we're not going to keep up with the supply meeting the demand. And so when that happens, those rents might kind of flex up a little bit. So I think as we're talking about things, we should think about measures that we go through. And again, it's, pressures probably need to be felt by all parties that are around development and living in the community and all that sort of thing. But actions that we take that add cost to deals will further exacerbate the problem. And that's just kind of one thing that we need to address, with the understanding that we still need to do something. And probably you're going to affect supply, but you also need to create subsidies that do that and incentives to kind of ramp back up supply. So, it stays complicated, but it does create kind of that urgency. And I think that's one thing that's come out, is that we need to figure this out soon, because the problem doesn't seem to be getting better on its own. And we're in the middle of, the earlier panels in the day, a lot of trends that are saying things are growing, things are going really well. So it's a good time to act, and a good time that, everybody's coming together. And so things we can do to know the rules, and kind of efficiently address the situation through being thoughtful about the decisions and the policy that'll shape our market going forward. So with that said, we're going to take about another 10-minute break, and then we'll come back for the final panel of the day, which again, very biased, but continues to be a good content panel. And so we'll explore case studies of what's happening in Raleigh, Durham, and Chapel Hill, seeing some really creative ways that local governments are working with developers, a lot of public-private, a lot of layering on different subsidies, different inclusionary affordability, different things like that, and having some really encouraging results. So stick around, and we'll see you in 10 minutes.